important to me, and guessing, I'm gonna take an educated guess that you guys will agree with me. Just give me 1 second. Just want to open up the Classroom. Huh. Open up the Classroom for a minute. Um, before we even get started, I just want to do this first. So just not for my friends that have joined me this morning, but also for anybody who, and I know all of you will be watching this. Hold on a minute. Can you guys see my screen?
Yes.
All right. So what I like to do, and I teach some other places online and on ground, but mostly online now. It's the summer. I want to just take a minute. I mean, it's a great weekend. It's the beginning of summer. You know, I'm looking forward to my wife has I'm 65 and a half. So thank the good Lord, you know, I've had my bumps and bruises, but nothing that was too serious, you know. Little things you get as you get older, right? Hernia, things like that. And I always had it. This hernia thing, when I had it, was about 4 years. It was not. It was like the beginning of COVID. It was like believe it or not, when I was born, it was just something they screwed up above my belly button, and it was always a little compromised when I played. You know, I just lived. It didn't really like wasn't anything bad, but you always knew that there was that it wasn't 100%, and eventually I had to get fixed. So those are the kind of things, you know. Then I broke my hand once, but right during COVID, and that was a headache. But and actually coming out of a school building, but down here by the Jersey Shore. But listen, you know, that's those are things that happen. But at any rate, so now my wife is like she's in health nut, so she's got me on hot dog probation, even though I slip bologna into the house and stuff like that once in a while. But I said to her, listen, Linda, this is Memorial Day, and it's my right as an American to eat hot dogs. So I'm having some this week. A little potato salad, apple pie, and ice cream. But at any rate, more seriously, this is not really what Memorial Day is about. My dad was Navy. My whole family was in World War II back in the day. You know, I want to take a minute of silence to remember the brave souls that died on the altar of freedom so we could be here today. So just let's take a minute and remember that. And for those of you at home, the key word will be honor, Honor, honor. So let's just take a minute. Okay. May they rest in peace. Okay. So let's take a look at Unit 3, and let's look at oh, I gave you a guide. Pretty sure I did. Okay, so let's take a look at the spreadsheet. And stop me if something, okay, doesn't make sense. Just bear with me. Stop me if something doesn't make sense. Don't just let me talk, you know? I mean, I like that you let me talk, but don't let me talk. It's not making sense. So, I mean, basically, I'm giving you this help, right? But all you really want to do is take the previous year. And I think a few students had asked me about this, they're having a tough time. It's really not difficult. You're just taking what you see in the current year, B6, minus, and just for a minute, is Lestanda or was it James? Do you guys see this?
Yeah, I can see it.
Yeah,
Okay, and does that make sense, what I'm doing? I mean, I want to make sure I cover things so people understand it. You know, I'm not there with you in a classroom, so am I on track with what you have to do this week? Is there anything I'm missing?
Yeah, I looked through it and it looks right to me and it makes sense. So I think yeah, I think you explained it well and I think it makes sense.
I really do. I greatly appreciate it. All right, so good. So you know what? Look, it's funny, and I'm not just saying this to placate anybody. You know, if you have a good feel for numbers, and like some people just pick up on the accounting, and it just makes sense and counting. But sometimes, you know what, people have to give things some thought, and that's why we go to school, right? So if for those of you who've had an issue, you're just taking that previous year and you're lining it up against the current year, and you're looking at the change. So, for instance, cash went down. Now, what are we really trying to teach here? Well, this is just the reason why I give this to you is I don't want you. I'd rather the student spends more time understanding what they're looking at and trying to analyze a balance sheet. So this way they could use that in the real world than, you know, fussing around with the numbers. So you just put this simple, and I'll accept that and I'll give you credit. But what I want you to do when you give the written part in is that to understand that cash has gone down. That cash has not gone down that much. And another thing, if this was a company, and I've done this stuff for real companies, you know, I'd be comparing it A against other companies that they're competitors with, and B, I would ask questions where like almost like when a doctor looks at a blood test. So we look at short-term investments, and these went down dramatically. So there's definitely a place for a question. Why did the cash stayed the same? I would expect that if short-term investments went down dramatically, I'd see more cash. Because think about it, those would be two places where I would keep my cash, right? I would either keep it in short-term investments or long-term investments or cash, right? Because short-term investments are going to be treasury bills, you know, very short-term stuff. You know, I mean, if you're a huge company like Coca-Cola, it'd be commercial paper, all the kind of short-term instruments that you put because that's what, like, think about Coca-Cola. Let me use Coca-Cola for a minute because we all can identify with that, or McDonald's, but let's use Coca-Cola. So Coca-Cola is selling tons of this stuff every day. And just like a mom and pop store, they got to pay people every week. People expect you working for Coca-Cola. You want to get the Coca-Cola company, you want to get paid. So every couple of weeks, I'm guessing they got to get a check. And then every day they're getting cash from McDonald's and suppliers. So this cash is coming in and out. And you can imagine the enormity of a company like Coca-Cola, you know, $200 billion company, the largest soft drink company in the world. So they're going to either wind up almost like a bank. They're almost like their own bank. Well, same thing with McDonald's. Some days they're going to need cash. Some days they're going to have cash in their coffers. It's no different than if you ran a small shop and you're going to have maybe 100 million here or 500 million that has to go out. And don't forget, it's a global company. So it's a complex thing. I mean, the CFOs of these companies have to be the best in the business. So what do you do with this extra money? What happens if tonight, now it's Friday night, right? It's Memorial Day weekend in America. All of a sudden you wake up and, you know, I'm sure they have tons of information because they've got the best bankers and everybody else. And all of a sudden they see, hey, there's 199 million, no, $210 million that are going to come in as a net positive. Well, you know, it's not like you and I, when we have money in our bank accounts, they may sweep it over or you earn a little interest and you kind of don't even think about it. But they got to think about it because hundreds of millions of dollars, a quarter of a point, an eighth of a point, 10 basis points, which is 1/10 of a point. That means a lot. Do the math. Hundreds of millions of dollars, maybe perhaps billions of dollars of cash have to be invested in. And every last basis point, a basis point bottom line is when you divide a percentage by 100, but that's how you express it in finance, has to be invested. So you're going to want to know why they took stuff out of their short-term investments where they were earning maybe an extra 10 basis points or a quarter of a point, and what happened here. But when I look down, I see my short-term obligations went down dramatically, and there's a big part of my answer, right? So I owed money short-term, probably to suppliers, to people like that, and I used my short-term investments. I cashed them out to pay it off. That's what I would go right to the CFO and say, is that what happened? And I would expect a positive answer. Plus, their notes receivable went up a little bit too. So now you get an idea where that money went. Then inventories went down, so they're not carrying much inventory. So now again, I'm starting to wonder, you're not carrying as much inventory. And always remember something about inventory, right? From a business standpoint, you have to have inventory. Right now, of course, if you're a legal firm or an accounting firm or a Wall Street firm, inventory in a Wall Street firm is possible because you have to carry securities to sell and buy and sell. But inventory with service firms are really not an issue. But with most companies, without inventory, think about it like when you go shopping for a car. This is the best way I can put it. You go to a lot where there's just a few cars. Chances are you're going to say, I'm not sure if I want to buy this car. I'm not in love with that color. I mean, you're a human being, right? People, I know, like when we go shopping for cars, my wife is really big on what color, does it have leather seats? Because she always feels that anything that isn't, material is going to get dirty. She's big health and clean freak. So she always wants something that could be cleaned. And look, we're together 40 years, so I get it. So the long story short is when we go looking for a car, and we always try to buy a car. One thing I should say, we always try to buy a car. We get the most amenities for the best price. Like I drive a Buick Envision. I really felt my family was always a Buick family. So I always felt like you're always getting a good deal from them. My sister drives it too, because you always get a good deal. That for what you pay, they give you a lot is really how I feel. And actually, I bought mine in 2020, and I bought it. I was on lease, and then I bought it over, and I love the car. And we didn't use it as much because of COVID, so that gave me like more time. And my wife, she's literally on her 7th town and country. She loves minivans. I mean, the kids are grown, but she's that kind of person. But that's just an aside. But we always try to get the most value. Even my kids, I can see they're doing the same thing. But the point is, when you see all that inventory in a auto lot, you end up buying a car. Because then all of a sudden, I kind of like the car. Then you see the color. I mean, I'm not a huge color guy, but, like, for instance, my wife is. So you see a color you like, that's a nice color. The seats look nice. Then you take a test drive, and then you say, okay, the sight lines are good, and blah, 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 and you end up buying. So inventories are important, is what I'm trying to say. But on the other hand, inventory is dead money. When you're carrying inventory, you are carrying capital. You're using capital. So the fact that inventories went down, you want to ask management why they're not carrying as much inventory. Because my feeling would be in this particular case that maybe they're not doing the business they were doing. Why carry the inventory? Or maybe they're a little squeezed and they needed more cash. It begs a lot of issues. Right? Probably the right way to do it would be look at a trend over many years. Prepaid expenses went down a bit. So this is a balance sheet that looks a little like there's questions to be asked. After that, we do our ratios. You know that the current ratio is going to be total assets divided by current assets divided by current liabilities. Those numbers seem pretty good. And she just made a little bit of a mistake here, the student. But when you take out inventory, that's how you get a quick ratio. And notice inventory went down, so we would expect that to change. But she just went, she just had a little. She added up all the current inventory, like she added up all the short-term assets and divided it by the short-term liabilities. That's all she did. So you have to do. Just add up the short-term assets. And divide it by the short-term liabilities. And I'll be honest with you, I'm not going to lie to you. I'm not a million% sure. I didn't go ahead. I mean, I know these numbers were right when I picked them up, but I still have to double check them. You can always make a math error. Okay. But those numbers should hold up. So for those of you at home that were having trouble, you just got to remember your definitions, right? Uh, $585. I'm just checking this out. I haven't looked at this one for a while. And, I expect you guys to do the work, but sometimes if there is a mistake on the guidance, well, then, you have to, that's where you guys come in, And that's correct, right? That's pretty close. So, she just rounded off, which is what she was told to do. Okay, so that's how you would do it. I think this number might be off a little bit, the current again. I'm getting more like 2.1. I think she reversed these numbers. Okay. Oh, no. Oh, yeah, I think she reversed them. But anyway, that's how you would do it. At any rate, and you take out inventory to get your quick ratio. Now, these are car care products. This is cost of goods sold. This is the inventory. This is the inventory at the end of period. And your inventory turnover would be your sales divided by your inventory. So that's simple. So it would be 5640 over, hold on a minute. I always double check everything, right? 1382. How fast am I turning over inventory, right? And you want to just net out your inventory and divide your sales. It's your sales over your inventory. Okay. Okay. Any questions on that? And then, of course, when you take 365 and divide it by 32.12, you're going to get the number of days. It's just another way to look at the numbers. If I'm turning over inventory 32 times a year, well, then every 11 days I'm turning over inventory. Okay, so the sales are, so that's a number that, that's a number that should make sense to you. My two friends, is it making sense, everything I'm saying?
Yeah, it definitely makes sense. Is there like a healthy number that financial analysts look for inventory turnover, or is it different by industry?
Interesting question. I think you got to definitely look at it by industry, no question about it. So it is industry dependent. But the only thing I would say is this. When you're, now what'd she do here? I just want to double check. That's a great question. She took the cost of goods sold times, she used the formula. Good. Good. All right, good. Good. So the only thing I would say about that is that she did a good job. The only thing I would say is this. You have to look at industry trends, no question. And you have to be, and never make the mistake of saying, wow, person A is turning over inventory a lot quicker than person B with company B, so they're a better company. You don't ever want to make that mistake. The question is, like any other ratio, you want to ask the next question is like, why are you turning over inventory quicker? We had a client once, I just told a story last night at another class, that owned a fulfillment firm for the Jersey Shore. I live in the New York, Jersey Shore. I showed you in the beginning. I don't live far from New York City where I grew up, but I live on the North Jersey Shore. So this guy had a business here that I met through this family that I did business with that was a Wall Street family. And I tell you the truth, he was a creepy guy. But at any rate, because he was a very difficult guy to do business with, I tell you the truth, at the end when we were done with him, it's like, you didn't want to see the guy anymore. But anyway, he would say that he was like, his business relied on selling all the paper goods to different restaurants. And you can imagine if any of you, I don't know where you guys are, I think I'm not sure where you guys are all from, but if you go to Jersey Shore, there's a lot of towns, a lot of restaurants. This is the time of the year where they do business. And a lot of paper goods, the paper napkins, the paper that you clean your hands with in the restrooms and blah, blah, blah. And he used to brag that he turned over inventory 52 times a year. And when he first said it, I said to myself, how do you do that? And you're not, so till I actually went to the warehouse and looked at his books, I realized he was telling the truth. But then I thought about it. I mean, you're really working at the edge. And if new clients come in, or there's a busy weekend, and you know what the summers are like. Some weekends you may be sitting on stuff, and then some weekends, everybody comes out. And all of a sudden, like on a Saturday night, you need more stuff. And it's not there, you're gonna go to your competitor. And remember this in business, once you force a guy to go to his competitor, you're gonna lose that client. Because a new competitor is a new broom sweep. My wife's family, they have a saying, like when you get involved, it's a funny saying when they're Italians, right? We're Italians. They said that like when you meet a new girl or you meet a new guy, give it a little time. Give it a little time. Make sure that you know a little more about them because they say because a new broom always sweeps clean. And we laugh, but it's true, right? Any new situation, new broom sweeps clean. People are eager, they're happy. You got to get to know somebody. So it's the same thing with a client. The new supplier comes in, and of course, no matter what, they're going to want to make the best impression possible. They're going to want to get this person as a client, and they're going to be much more accommodating. So a new broom is going to sweep clean, and you could lose a client that way. So from a practical business standpoint, you absolutely want to make sure that you're taking care of those that you're taking care of those that you're making sure that you always deliver to your client. Always make sure you deliver to your client, because what happens in a lot of situations is when someone's been a client for a long time, it's human nature. Not everybody, but some companies will tend to treat it like a given, and then the person on the paying side says, I'm not feeling the same level of service or whatever, and that's where you can lose people. So you always have to remember your client has to be treated every day like it's a new client. But that's just a little something on my. So the balance sheet for Rainbird Car Wash at the end of the year looks like that. Your income before taxes was that. Your income taxes was that. So basically, what you're going to do is you're going to break it down. I'm going to leave this up to you, but you're going to net out your earnings versus your taxes. You're going to have earnings versus your taxes. You're going to pay out dividends. And then when that's all done, your earnings per common share will be your earnings over your number of shares. So remember that. Your earnings will be, now there you go. You got 5 million, I believe you got 5 million shares. So your earnings are going to be always before your number of shares, which is 500,000 shares. It's $10 a share, right? They don't give you a stock price. They just tell you the par value. So notice she made it C40. Then she took $3 million of earnings. Here's your income before income tax expense, right? And she divided it by, and then she did a great job. Then she took away $1.2 million, which was her income taxes. And then she divided by 500,000 shares. She made $360 a share. Then a PE was, she divided by earnings per share. So a price earnings ratio. Let's see what you get. And then she looked at the dividends per share. I'm looking at this. She made one error. Does this say anywhere where the stock is at $32? I don't see that. I thought the only price of the stock I saw was $10. Gotta check that one. Earnings per share. So she took the earnings. Earnings per share is your price earnings ratio should be your earnings divided by price. So she got that number. You see something. I gotta check that number out. That number does not look 100%. But let me check that out. I'll get into it. I'll give it back to you in a minute. I just want to, I'm gonna double check that number. And then you got to write an APA formatted paper. So you could use some of the concepts that I just used to write that paper. You could use some of the concepts that I used to write that paper. That makes sense. The dividends per share makes sense. The earnings per share makes sense. Right? Was there, let me ask something, John, or Stonda, do you see a price per share in the stock here? I did. I just see the $10 par. You guys
Yeah, I
see?
think that's all I see too.
Yeah. So like, let's say for instance, let's just do something different. Let's say for instance, I keep an eye on this. That's why even though I give you guidance, always double check the numbers because there can be errors. Or Yahoo Finance. If you look at a company like, say, for instance, I'm going to use Apple. And now with Apple, and price to earnings ratio is really important. It's, to me, one of the most important metrics. I'm going to go over in a minute, but the price earnings ratio is 29.49. So if you take the market cap of 2905 and divide it by if you take the earnings per share, 643, right? If you take the earnings per share of 643 and take the price of the stock, which is 189.38, and divide it.
I see the $32 now, sorry.
Okay, hold on. Stay with me 1 minute.
Okay, yep.
43. You're going to get 29.4, which is exactly the PE ratio, which means that investors are paying $29.4 for every dollar of earnings. And I'll get back to that in a minute. So tell me out here, James. I just want to make sure that that's right. Are you seeing the spreadsheet now?
Yep. So look on row 41 where it explains the income before tax, and then just scroll over to the right, kind of far to the right, you'll see where it says the common stock was selling for $32 per share at the end of the year.
Okay, there it is. All right, we got it. Okay. So
Sorry to
32.
interrupt you. I didn't want you to get
No, that's great. You know, I can't see it I couldn't see it on my screen. That's excellent. Okay, so that's the price earnings ratio. What confused me too is it shouldn't be expressed in dollars because it's not a dollar thing, but that's why I'm nitpicking. All right, good. Thank you, James. All right, so that you would explain that and you'd be fine. So I'm going to stop sharing this for a minute. So that should help you now. And then you write up your own, based on what I said, I want you to write up your own analysis. I want you to write up your own analysis. So now what I want to do, I always want to make sure we're recording. Oh, good. So, you know, it's sometimes with these systems, the one thing like from a teacher standpoint that always makes me nervous is like if I was recording correctly. All right, so let me know that you could see Yahoo Finance.
Yes.
Okay, just give me 2 minutes because I just need to make a quick pit stop and we're going to talk a little bit about this. It's 2 seconds. All right, I'm back. So look at Apple for a minute, right? Apple trades at 29 times earnings, right? and a beta of 1.26. Those are the numbers I look at very closely, before I even start. Now, obviously, if you ask me about Apple, being a student of this stuff for a long time and being involved in finance, I mean, I know what Apple's about, right? I don't need to like think about it. But that doesn't mean the same for every stock. Like yesterday, some student told me, take a look at Lockheed Martin, which I'll talk about in a minute. And all of a sudden, opened my eyes and said, that's a really, yeah, because you can't just look at screens. Screens are good, but if you don't know why the company, like if you look at a screen now, the most reasonably priced companies are generally oil and gas companies, only because oil prices have gone down. And it's, as much as and I'm sure they're getting paid well, the people who run these companies, and that's business. But the bottom line is, from an investor standpoint, it's expensive to take oil out of the ground and process it. So those companies are trading at not very big valuations. And then there's some companies that are ridiculously valued. So how would I teach you how to do that? Well, the first thing I would do is go to Wall Street Journal. Now, I'm going to say this again and again and again. If you don't learn anything from my class, then you get a subscription to the Wall Street Journal, which from a student standpoint is like $50. It's not a lot of money. It's like $50 every 6 months, I believe. And really spend time and spend the time to read it and get involved with it every day. You will have applied what you're learning, and believe me, you will see such a benefit to it and so many opportunities for you to better your financial life and your life in general, because you'll communicate better, a lot of good stories, obviously very well written. It's the business paper record. A serious business person has to get information every day. And believe me, from a professional standpoint, this is what people do. So we go to US stocks in this particular case. And then we go down to index PEs and yields. And when we get there, we'll see that the S&P 500 has a 21.62 price earnings ratio going forward. And that's the number I want to focus on, because what it tells me is that the market, if they project earnings, not where we are now, but where we project it, should be about a 5% yield, right? If I'm paying $21 for earnings, and I'm going to round it off and make it 20, because it's not an exact science, it's the S&P 500, right? The largest industrial companies in our country. So if I round it off and give it a little room, and I say I'm paying $20 for earnings, well, if I'm paying $20 for $1 of earnings, I'm earning 5% yield earnings. And then if I look at, and one of the things that concerns me, if I look at the risk-free rate, which is the 10-year bond, I'm generally picking up an extra, and this moves all day long. So let's make it 4.5. Let's be as generous as possible. So we can assume that we're only going to pick up 50 basis points or half a point by taking the risk of the market. Which, I mean, logically, it's just, to me, not, it's at a relative low. And so then I got to ask more questions, like, why is that? And so when I go back to Yahoo Finance and I start looking at individual stocks, that's where I can begin my journey of understanding. I could start understanding. I could begin my journey to understand why this is happening. So when I look at a stock like Apple, that tells me it's a little overvalued, because the market's already overvalued, and Apple is trading higher than the market and pays less of a dividend. The average dividend, at a 0.5%, it's a very low dividend. And then the beta is 1.26. So what's happening here, if I look at beta, that's my relationship of my stock to the market. So if the market is up 1%, I regress Apple's prices to the market over 5 years monthly. And so it's a pretty good regression, because we're going back 5 years. And it tells me that Apple moves at a 1.25 velocity to the market. And if the stock market comes down 1%, I should lose 1.25. If it goes up 1%, I should make 1.25. But not totally unreasonable value, because I expect Apple to grow a little better than the general market. So I'm looking at this without doing a hell of a lot of work. I'm saying to myself, all right, if I had Apple in my portfolio, it's probably reasonably priced. Within, of course, a variance of 5 or 10%, but it's probably reasonably priced. Then a stock that I own is Ford, which is kind of like one of these stocks that just goes unloved. I also look at, another thing I look at is market cap. So it's a $3 trillion market cap. It's one of the biggest companies in the world. So we know that, but that's a good way for me to start because now I can see the biggest company. Then I go to Ford, and that's Frank Root. I don't know why that's happening. Always watch your big companies too. You always watch your commodities because that teaches you a lot. But anyway, look at Ford. It's a 12 PE. It's ridiculously cheap, but it stays ridiculously cheap. It's one of those things that's cheap. And GE was like this for a long time. Walmart was like this for a long time. Then you wake up and it just gets normal again for a variety of reasons. But usually it's like people finally realize it's a company that can deliver earnings. I mean, this is Ford. I mean, give me a break. But at anyway, 1/12, you got almost a 9% yield. You're picking up a 5% dividend. So even if you don't, if you say I'm going to leave my money in a money market account, maybe not the worst thing I'm thinking, and this is what I did, is leave some money in Ford. And then I got a pretty high beta. So I do got some vol here. But that's only because the stock bounces up and down between 12 and 13 all the time. So I know the stock. And what's even crazier is Ford's market cap is $47 billion. Now let's look at Tesla. When I get to Tesla, I've got a beta of 2.5, very volatile. I got a P of 45 times, and the company has had its headwinds, right? 45 times. I'm getting like a 2% yield. And the market cap is 12 times the market cap of Ford. I cannot get my head around that. How Tesla can have 12 times the market cap. Even NVIDIA, which if you look at the Wall Street Journal today, and I'm going to point something out to everybody. NVIDIA, yes, AI is incredible. And I'm still not sure exactly how they're going to make money, but I could see that it just has incredible possibilities just from viewing it, right? But this has got a $2.5 trillion market cap. It's got a high volatility. It's got 60 times earnings. And then when I go back to the Wall Street Journal, and this has been one of my chief concerns with NVIDIA. Let me see if I can find the article. I know I saw this article today, so bear with me. Bear with me 1 minute. Okay. And it was in today's paper edition. All right. And here it is. I don't know why I can't find this article, but in the front page of today's paper, show it right here. NVIDIA surges faces tests from rivals in the market. So what they're saying, if you look at it, is that the market, there were competitors, countries even like Japan, like China. God love them. Hey, look, I'm an American through and through, obviously. But hey, they know how to copy things. So I wonder, just from a practical standpoint, how long is it before they start copying what's going on there? And that's an issue, because if you can compete, people want to buy things. These things are not available. It's definitely helped that they have this advantage, right? People are using it for AI. If the stuff is not available, well then, and now it becomes available. I'm going to go to a competitor. But for some reason, this isn't showing up, and I'm not sure why. Let's see if it's here. Here we go. NVIDIA's business is booming. Here's what could slow it down. Rivals and customers are you're looking to produce chips that can close the gap. I mean, that's going to happen eventually. When someone's catching fish, other fishermen are coming. Am I saying that they're going to go down to zero? Of course not. The market's going to grow. Nvidia is going to keep a nice share of the market. But to think that they're going to dominate the market like they are now, I just don't see it. And I think the stock is rich. Now, you got to remember, and this is why the markets are expensive. Markets are expensive because, and now we see Microsoft is introducing, but Microsoft, I read an article, Microsoft is bringing in an AI product, but they're using it with ARM, which is a chip maker out of the UK. My feeling is, people buy on emotion, and they buy because they're making money. They don't buy on value. And just the guy who runs JP Morgan Citicorp just said that. He goes, people are not buying on value anymore. So think about that for a minute. If you're not buying on value, you're buying on emotion. They're driving some of these stocks, and when you have these outsized PEs, they drag the whole PE for the S&P 500 up. So you do have a number of stocks that are reasonably valued within the S&P, which is stocks you want to generally think about owning. But then you have a bunch that are so overvalued. So my feeling is if you're too overweighted in those stocks, right now you're probably happy. But the day of reckoning could come, and when does that day come? We've seen it happen so many times in the past. So Intel is generating new chips. Amazon, Meta, Microsoft are opening up another front, designing their own chips. I mean, look at this. How long? It's just a chip. It's not like when Microsoft had or Google invented basically the modern search engine. It still could be attacked, but there was a lot of moving pieces. It was very hard to get people to move. Think about it. We all use Google. A lot of us use Google. Yes, even if a better system comes up, it's like I got my email there. I can do a lot of stuff on Google. I have schools that are using Google. But here, it's a chip. I don't even think about a chip. I turn my computer on. I expect it to do things. If somebody puts in it's like an engine in your car. If your car's driving well and the engine's good, I don't give it a lot of thought who built the engine, as long as the engine's good. So that's my problem. But before it goes to 500, it could go to 2,000, and that's the problem with emotion in markets. It's not rational. But right now, I'm starting to feel it's not rational. The action in Nvidia is not rational. But again, if you're counting on those profits because you're in retirement and you need the extra money, this is where it starts to get dangerous. So that's just my feeling. It doesn't mean I'm right. It's just an opinion. Right? But it gives you an idea. Now I'm trying to show you how I don't just look at the numbers and say, well, the P on the S&P 500 is X, earnings are Y. You got to dig in. And there's my point. If you're reading the papers every day, then all of a sudden now you know where to look for the issues. Like if you follow sports or anything, or cooking or anything like that, it's not just you start to understand where you have to look. Now look at Lockheed. A student pointed this out to me last night. That's why I love teaching. You got a P of 17, which is better than the markets and relatively reasonable, right? If I buy Lockheed Martin, I'm going to get a P of 17. Okay? And think about what Lockheed Martin does. I mean, it's an aerospace company. That stuff is going to be around for a while. So 1 divided by 17 is a 5.8% yield. So at least now I'm getting 1.5% over treasuries. Small market cap. I mean, could you believe this? It's 1/5 the size of Tesla. It's low vol, right? Because it's so steady because they got so much government work. And you pick up a 2.7% dividend. Lockheed is a very reasonably priced company. But there's problems, and you got to dig into those. They say the earnings have hit a wall. So I would say the question for Lockheed is really, what does the election look like? Because a lot of this is government driven. Is that going to be the kind of thing where they'll see more business once the election is over? I'm not sure who's going to be president. I won't get into politics, but that's the question you would ask. So that's it, guys. Any questions? Any questions?
No.
So I hope you enjoyed today's class. I hope you for you and your families.
Thank you. Have a great weekend.
Have a great one. Have a great one, Lestanda.
You have a good weekend. You too.
You too.
Thank you. Thank you.